Good morning, everyone. I would like to call this meeting to order. It's 9 o'clock. Hope you all have a wonderful morning already. My name is Vincent Hao from VAAC International, and I'm your July MOS Program Chair. So a little bit about me. I'm came here from 2002, and I finished my master's degree from USC for construction management. And so I have been working in the construction field for couple years, everything being very promising, looking good until 2008, the subprime crisis, like everything crushed, just crushed. So at that time, we are seeing like a general contractor laying off all their employees, and the developer cannot get a loan from the bank. So it's very sad time at that time. But just as the saying that when one door is closed, another one is open. So we're very fortunate that we have been able to do the real estate business. So I started my own firm from 2009. I remember I calling my brother said I'm going to open my company. It's a 5 or 6 p.m. our time, and he works in Wall Street, so it's nighttime in New York. And he heard me that I'm going to open my company in 2009, and he said at this time, and then it's like a complete silence for a couple of seconds, and then he just told me that if your kids need a tuition, just let me know. But very fortunate we never need like a tuition from him because my kids goes to public school. But it's very been blessing since that time. Everything is growing. It's a wonderful time for us. So very happy to be here to be your July program chair. Thank you. So a few house tip that all participants will be muted upon entry to the MLS breakfast meeting. And if you have any question or comment, please enter into the chat box and the host will read it during the question and answer portion at the meeting. And please remember to join us weekly for the breakfast meeting at the 9 o'clock on every Thursday. Please register in advance for this meeting. And after registering, you will receive a confirmation email containing information about joining the meeting. And please remember to follow us on all the social media. We are on Facebook, YouTube, Twitter, Instagram, and we have a new feature for the text message service. Just text WSGVR to 72727, and you will get an update like today's meeting. Quick tip for the quick tip this week, this is a new one. I received a citation notice. What do I do? Just make sure to correct the violation to prevent the issuance of additional citations. If the violation was corrected on your behalf by CRML's staff, this information will be included within the citation notice. Within 20 calendar days of the day of the citation notice, you can either pay the fine assessed or you wish to contest the violation and the associated citation. Submit a citation review request from online no later than the citation review deadline noted on your citation notice. If the fine is not paid in full, nor is a citation review request form submitted within 20 calendar days of the issuance of the citation notice, your access to MLS service will be suspended. If your access is suspended, the only portion for reinstatement is payment in full. You can visit www.gocrmos.org/compliance for more information. And for today's agenda, we have affiliate spotlight Marcus Jack, Western Resource title, and followed by our speaker Judy Chow, Mario Manzanilla, Joseph Haggerty. And to be eligible for today's raffle, you must be a WSGVR member, and your name must be displayed to win. We will not accept telephone numbers. And for affiliate spotlight brought to you by our affiliate committee, Chair Sage Gomez, my NHD, Vice Chair Brendan Savransky, First American MHD. So for today's affiliates, please remember this is just a morning greeting. First, we have Nancy Chen, lawyer's title.
Good morning. Thank you, Vincent. Thank you, everybody. Good morning, Nancy Chan with Lawyer's Title, 40 years in the business, here to service you. Thank you.
Annie Fan, Chicago title.
Good morning. This is Annie Fan, Chicago Title. Happy Wednesday. Thank you.
Sandy Franco, First American Home Warranty.
Good morning, everyone. Sandy Franco, First American Home Warranty. Have a fantastic Thursday.
And the next one, John Wax, Snap MHD.
Good morning, West San Gabriel family. I just wanted to say, hope you're having a great day. I'm John Wax with Snap NHD for all your NHD and environmental and tax needs. Bring you 27 years of experience. Have a wonderful day. Be safe out there, and let's sell properties. Thank you.
NG10, Stewart title.
Good morning, everyone. Angie Tang with Stewart Title. Have a wonderful caravan. Thank you, Vincent.
Judy Chow, AAA Capital Investment.
Morning, everyone. We'll be on the panelists today, but
Judy, you've been cut off.
Okay, good morning again. This is Judy from AA Capital Investment. We'll be on the panel today, and then also wish everyone a great week. Thank you.
And next we have Sage Gomez, my NHD.
Good morning, everyone. Sage Gomez here with my NHD.
Maria Howard, Old Republic Home Protection.
Good morning, everyone. Maria Howard here with Old Republic Home Protection to help you with all your home warranty questions and concerns. Have a great day.
Cosmo Sanchez, New End Funding.
Good morning, everyone. Cosmo Sanchez with New Aim Funding. Thank you.
And the next one, can we have the next slide?
Belane's having technical difficulty today.
So please remember to support all our affiliates for the business. And Mark Wu, Allstate Insurance.
Am I on?
Yeah, yes.
Okay. Good morning, everybody. Mark Wu with Allstate Insurance for your property insurance needs, servicing the San Gabriel Valley for over 33 years with the same company. Have a fabulous weekend.
Joseph Haggerty, Orange Coast Title.
Hey, good morning, everyone. Joe Haggerty with Orange Coast Title. Happy to be here today. Thank you.
Brendan Savetsky, First American NHD.
Good morning, everyone. Hope everyone is having a fantastic end of the month. This is Brandon Spransky with First American NHD. Go Team USA. I don't know if you guys saw Sunny Lee won the all-around gymnastics, but she kicked butt. So go team.
So open pitch tie, but today we don't have any open pitch listing. So let's just go to the next one.
Marcus texts me, he's having a hard time signing in. So let's just move on with the program. When he comes back, we'll go back to him.
Okay, no problem. So for today's speaker, help me welcome today's moderator, Sage Gomez from my MHD, who will introduce our panelist. Sage?
Good morning, everyone. Sage again with my NHD. We are going to talk about lending today. So we have two lenders for you and we have one title rep. All the questions are revolving around lending. So please pay attention as we're going to answer the Q&A at the end of the presentation. So we have Judy Chow with AAA or AAA Capital Investments. We have Mario Manzanilla with Rate One Financial, and we have Joe Haggerty with Orange Coast Title. And then please write their information down. So if you need any help with lending or title, their information is right there for you. So let's begin. We're going to start with Judy. Judy.
Good morning.
How are you?
Fine. How are you?
Good. Okay, so we're going to ask you, what are Fannie Mae and Freddie Mac loans?
Okay, Fannie Mae and Freddie Mac covers about 95% of the U.S. mortgage loan, and that's approximately $5.7 trillion. And they're both sponsored by the US government and regulated by the FHFA, which means Federal Housing Finance Agency. And they are strongly supported by our Federal Reserve. The Federal Reserve is the biggest investor buying these loans. They call them mortgage-backed security. They buy about $4 billion per day. Because the Federal Reserve buys them, we can keep the interest low for the consumer. Otherwise, there might be hardly any investor, very few buy these loans since the return is so little, it's below inflation. You saw the latest CPI report this week is above 5%. So you're getting interest rates so low. So the current 30-year rate, fixed rate is around 2.375. And the 15-year fix is 1.75. It's historically low. And the documentation for these loans, Freddie and Fannie, I would call the full doc, are the basics, 2 + 2 + 2, meaning 2-year W-2 or 2-year tax returns, 2 paycheck stub, and 2-month bank statements. They do offer the best conventional interest rate for your qualified buyers. I have a little bit about how many minutes I have left. I only have 30 seconds or a minute left. Okay, I can talk a little bit about, you might add this question, I'll just answer now. Is interest rate going up or down? Okay, so this is a very important question every day. Well, it depends on many microeconomic factors, stocks, the pandemics, and also inflation. Inflation might be the biggest measure now because the Federal Reserve are buying these every day, and on Congress, they tell them to stop buying. So at the next Economic Policy Symposium on August 26th at Jackson Hole, Wyoming, the Federal Reserve would discuss inflation interest rate. They come out of this meeting and decide that we should start tapering down buying this mortgage-backed security, then the interest rates will go up. So those are sort of the sign to watch.
Okay,
Thank you.
cool. Thank you, Judy. And next up, we are going to ask Mario a question. So what are the 4 C's for obtaining a mortgage?
Well, good morning and happy Thursday, everyone.
Good morning.
Actually, this one adds to what just Judy explained. Because we're guided by Fannie Mae, Freddie Mac, which is 95% of the loans. This is great. So the 4 C's are this: capital. That's number 1. Basically, down payment. Where is this down payment coming from? And the reason why they want to source it, if it's a gift or what have you, is because they want to make sure there is no money laundering or is illegal money going into the transaction. Remember, we're guided by the federal government, right? So this is why so that's capital. That's number 1. Number 2 is capacity. How much can the borrower afford? The real thing here is, can he make the payment? These are guided by the investors. Remember, it's the Federal Reserve and the banks and everybody, so the real kind of nutshell it would be 50% of their gross income. For example, $10,000 gross income was 50%, that's $5,000. That's about, I'm just kind of using that as a guideline because that's what's happening. FHA is 55%. So there are some little variances here and there, minus the debt. Okay, so that's kind of, they want to make sure that he has the capacity to make the monthly payments, right? Because nobody wants to lend to somebody that cannot afford it, basically. So that's capacity. That's why the debt to income ratios, that's what that's all about. Number 3, most important, credit. Well, not most, there's part of the 4 C's. Credit is a measure of risk. If you were a landlord and you have 2 options, one tenant comes in and wants to apply for your home, has a 580 FICO score, bankruptcy 3 years ago, and the other one has 740 credit score, no bankruptcy, clean, which one would you rather have your tenant, right? That's exactly the same kind of view with credit. It's a measure of risk, and we think, how is this going to pattern of payment? Will this be problems in the future? And rates also indicate interest rates. So a lower FICO score, they're not going to get the 2.375. If you got a 580, I almost guarantee you're not going to get no 2.375. They will be a little higher than that. So, okay. And collateral is the last one. It's just simply based on appraisal. That's the value of the home. That's the 4 C's. We need all of them because that is for a pre-approval. And this is my last thing. Those are the ingredients like baking a cake. You cannot only have good chocolate here and not having the rest. So think of it like baking a cake. You have to have the 4 C's so we can meet the guidelines for Fannie Mae and Freddie Mac.
Okay, thank you so much. Also, I just want to apologize for if there's any noise in my background. I just chose to be outside because I have family members inside, and sometimes my brother or my dad like to walk around shirtless, so I wasn't going to make you guys see that. So I wanted to be outside just in case.
You want to see it.
So I do apologize if there's any background noise. So Joe is next. Joe, why does a lender require title insurance?
Yeah, so, a lot of people ask this because they think, well, it's, everybody, kind of questions every fee in a transaction. And while Mario was talking about the 4 C's, you should add a T to that because the title insurance is actually protecting the security interest of the loan in a few ways. The main thing is that the lender wants to know, they want insurance, they want assurance that they have priority over any other lien on the property. And so during the escrow transaction, they're, for their first looking at anything on the preliminary report that sounds like it could be some type of lien or something that affects the property, in a lien sort of way. And they want to make sure that all that stuff is cleared up. In the event that something was overlooked, a lien was overlooked or not found during the escrow transaction, and there was no title insurance for the lender, it could affect, if there was later a foreclosure or something, they would lose out on their investment of the property. So during the transaction, title has to make sure all liens are cleared, and it's a condition of the lender.
Okay, well, thank you for explaining that because I didn't know that. So always good to learn something new every day. All right, Judy, what are DU and LPA approval?
So a lot of time, if your agent making an offer, the listing agent may ask you, I want a DU approval. What is DU approval and what is the LPA approval? DU stands for desktop underwriting. It's the automated underwriting system used by Fannie Mae to approve a loan. LPA stands for Loan Product Advisor, and that is the automated underwriting system used by Freddie Mac to approve a loan. So usually they want this along with instead of just an approval letter, pre-approval from a bank and a mortgage broker, because these approval went through both the process of Freddie Mac or Fannie Mae approval. So, and once your loan is DU LPA approved, the loan is about 95% good to go for full approval and funding. Our office can provide DU LPA approval within 24 hours with all the needed document. That's the 2+, example, the 2+2+2. Okay. Thank you.
Thank you, Judy. That's good to know. So Mario, are reverse mortgages easier to qualify than regular loans?
Absolutely. It's interesting that we've been talking about Fannie Mae, Freddie Mac, and all of these loans. But reverse mortgages is how I'm going to put it. This is the contentment and health is more precious than gold. So really what it comes down to is age and equity. Those are the two main components to qualify. You have to be 62. The older you are, the more you get. The interesting part about reverse mortgages, there's no debt to income ratios calculations. There is no, none of that is applicable. They just want to make sure that they have enough money, which they call it residual income, to make sure that they can pay their taxes and insurances. It's a very simple formula, income minus expenses, and that could be Social Security, pensions, whatever, because they know that most of them are no longer working, So if you're 62 or you're 74, who gets more? The 74. You're 80, you get more. So reverse mortgages are a lot easier to qualify than the regular loans because they are based on just age and equity. So there's no debt to income ratios. They do run credit, by the way, and it's not driven by credit, but the only difference is that they want to make sure there are no liens and there's several, making sure that they have the at least because there's no mortgage payments. So that's the beauty of this transaction. The requirements are a lot less strained, almost like a stated income. They just look at certain things. That's it. Very, very easier to qualify.
Okay, well, thanks for letting us know. I'll be sure to contact you when I turn 70, okay? Okay, Joe. This is a scenario. So I bought a lender policy when I purchased my home. Why do I need it again for a refinance?
Well, so, I mentioned earlier that this is the lender is the one being insured, for, they have loan priority and everything. Once the loan is paid off, the term of the loan is over, that title policy is no longer valid. It's not like reassigned to someone else. If a loan was sold, to another investor or lender, the title insurance could carry over. But in this case, when you're getting a new loan or a refinance, the new lender needs a new title policy. And they also, there's time that's gone by. So they, again, need to make sure that there's no other liens that could affect that new lender's security interest.
Okay, thank you for explaining that. Judy.
Okay.
Judy, which type of non-QM loans are good for investors?
Okay, I think Mario will cover a little bit about non-QM. Non-QM means non-qualified mortgage. It doesn't mean it's a bad mortgage. It does not mean the subprime. They are just alternative document loans. So for conventional loan, your buyer may need to provide 2 years of tax returns. So if this person has a business, then you mean you have to do 4 of them, 2-year personal, 2-year business. And they have 2 business, you need 6 years. So, and an IRS transcript, so forth. So non-QM will not need this and be much faster, easier for approval. Also for conventional Freddie and Fannie loan, property must be under personal name or living trust. Non-QM can do loan under LLC. Okay, so has a lot of advantage. And one more is that, Freddie and Fannie only allow you to have 10 properties on loan being financed, but non-QM, you can have up to 50. And one of the product, no limit, you have 100 property. And by the year 2022, which is next year, a lot of the mortgage-backed security investor believe that 50% of the mortgage loan will be non-QM. Then you'll cut into the 95% of the Freddie and Fannie. So there are a lot of investors buying this type of loan, and they're a good loan. So for investment property buyer, the preferred non-QM loan is called DSCR. Some of you might be familiar with the word, debt service coverage ratio. They use this for commercial loan a lot, for apartment, for hotel, for different kinds of income. So it's a good program for investment property because they don't require income documentation of the borrower. And for example, I have a lot of borrowers that own like 10 property, 20 property. Traditional loan, they have to provide all the documentation for these 10 and 20 property, like mortgage statement, property tax, insurance, HOA. But on a DSCR, it's strictly based on the written income of this property, which means, for example, if you buy a property, investor buy investment property, rent income is $3,000. That can support the principal, interest, tax, insurance of about $3,000, which is about $450,000 in loan. So meaning your buyer can buy a $600,000 investment property with 25% down. So it's very, very easy. So if you have investor looking to buy without providing a lot of documentation, DSCR non-QM is the way to go. Okay, thank you.
Okay, thanks so much. Mario, why are reverse mortgages a solid purchase loan consideration for clients over 62?
Great question. Just before, I just want to add one comment from Judy. For all of you, non-QM loans are a little higher interest rates, so don't expect to compare with Fannie Mae loans, okay? So that's one of the, but to answer the question, reverse mortgages are great for seniors. There's 2 or 3 reasons. One, the seniors, when they sell a home, and they want to buy something to say downsize or right size, however you want to call it, they don't have to use all of those proceeds to buy the new home. So say, for example, they sold $1 million home and they got $500,000, or $600,000 because they owe 400, they paid all. Now they have that cash. It's their cash. So what can they do with that? A lot. They can fund their long-term care planning. They can buy investment properties. Incidentally, buy even when the new purchase, by only putting 50% down, they can add with that money that they have, add an ADU instead of putting all of that money into that and have nothing. And in the future, then that could create a situation for funding their own retirement. So it opens up a lot of possibilities. And I have seen that quite often lately, how some of these benefits is quite exciting. But to say it is a solid idea for purchases because they will not have a mortgage payment. That's the main thing. And they can use that money for whatever they wish to use it for, instead of paying the bank a mortgage and qualifying for that loan. Because as I said before, they're a lot easier to qualify even for a purchase.
Okay, thanks so much. Joe, this is another scenario. I have a tax impound account with my lender from when I purchased my home. Will I need to pay the supplemental tax bill separately?
Yeah, so this comes up often where homeowners, they just bought their home and they think, oh, I don't need to pay my taxes because it's all included in my mortgage payment. Well, that's partly true. They've estimated what your taxes will be, and they're collecting the right amount of money, most likely to pay the current bill that's due and the supplemental bill that's due. But the lender in almost every case does not get a copy of the supplemental bill, and they do not pay it on their own. You have to call your lender to find out if there's any special situation where they might pay it from your impound account. But if not, you will, in most cases, you likely do have to pay it out of pocket, but so basically check with your lender. You can also consider as a borrower that if you're paying enough into your impound account, there will be a surplus at the end and the lender will send you the difference back.
Okay, cool. Thank you. Just a reminder to the speakers, we have about 10 minutes to answer your final 2 questions, but keep in mind that we need to use some of that time for the Q&A as well. So Judy, which type of non-QM loans are good for borrowers without enough income to qualify?
Okay, I'll talk fast. Okay, this will answer the question that Joanna Liang has asked. She asked for retired people without regular income except pension, Social Security. How do they qualify a loan or account it as income? It doesn't have to be retired people. So there's the non-QM loan called asset depletion. It's offered in Freddie and Fannie, but the non-QM is much, much better. So if the borrower has money in stocks, mutual fund, bonds, saving, IRA, 401k, retirement fund, we can use these funds to calculate the income of the borrower. So the borrower has $600,000 using the non-QM, the asset depletion, he can qualify, or he or she can qualify for $580,000 in loan. So it's important to keep in mind this program. This is a lot better than the Freddie and Fannie because they amortize over, they calculate your asset by 7-year period and not subject to age requirement. You can be 40, you can be 45. Where Freddie and Fannie, they have to be age 62 or over. And also this fund divides over 20 and 30 years respectively. So in other words, if you have $600,000 in non-QM, you can buy this, get a $580,000 loan. But if you had it in using Freddie, you can only get $120,000 in loan. And Fannie, you can only borrow $25,000. It's probably good to buy a car. So you see the difference on non-QM. It's a lot more easier and better for the borrower. So I hope that answered Joanna's Liang's question. Thank you.
Thank you so much. Mario, can I use the proceeds from a reverse mortgage to buy an investment property?
Absolutely. I have a realtor that actually got 3 deals from one person that sold in the Oxnard area. Okay, then obviously he bought with a reverse mortgage and used the proceeds, half of the proceeds that they had, to buy an investment property. The realtor handled all of that. So now you have a person that not only has no mortgage payment, an investment property, and the sale. So in addition to those proceeds can also use for ADU. I actually received this interesting flyer here from an ADU United Dwelling. You collect $20,000 in rent cash a year. Can they use an ADU for some of that? Absolutely. So the answer is really yes. And how do you do that if you don't qualify for the age and equities for the reverse mortgage, but now you have to qualify for an investment property? Well, that's when you use the non-QM for the investment property. Is to put 50% down, and then we say, well, gee, now they have income for the rest of their lives, and if we're putting that kind of cash down, guess what? They're gonna qualify just based on the mortgage payments that on the payments that they're receiving, because their mortgage payment most likely will be less than what they're receiving. So you can see that the opportunity is not just the reverse mortgage, it can expand to ADU, can expand to investment. And I have actually seen that already. And it was like, wow, it opened my eyes through a realtor that got 3 deals out of the of one sale. And now no mortgage payment, and all of those advantages came to be. So yes, it can be used. You can use it for anything, really. That's your money. There's no, you can sell your property at any time. There's no prepayment penalties. You can pay the reverse mortgage if you want. A lot of flexibility. So that will answer the questions there, hopefully.
Okay, thanks so much. And once again, I know who to go to when I'm when I'm eligible for that. Okay. Joe, what lender documents are important to keep in my records, and for how long should I keep them?
Yeah, so some of the lenders might be able to shed better light on this, but obviously, like your loan, your first like loan documents that you sign, you may keep them until the loan is paid off. You may even keep them a few years after. You may keep a copy of your statement, every now and then, so you have something to refer back to, call your lender, etc. Always, like, if the lender changes, you might want a copy of, keep copies of those statements so you know who the current lender is. But more important than anything is when you pay your loan off, all the documents related to paying your loan off that come to you, even just that letter that says congratulations, your loan is paid in full, that may sound like a silly, oh yay, let's shred it tomorrow. No, keep everything from when you pay off your loan, keep it forever, because there could be a time where a title company, I know a few, they could call you and when you're refinancing your house, or maybe you're selling your house, or even you've already sold your house, and they're trying to clear up this loan that maybe it doesn't reflect as paid off online in the title world. It's good to keep those records forever. Keep them in a safe, keep them with your most important documents, the paid in full, the final, all the payoff stuff. Keep it.
Thanks, Joe. And I'll remember that for the future. Okay, so we have our final questions, and so far the speakers are doing amazing. I'm learning so much, so thank you for being here. Judy, what type of non-QM loans are good for self-employed borrowers?
Okay, self-employed borrower can use 2 types of non-QM mortgage loan. One is called a bank statement loan program. They can use 12-month bank statement or minimum 3 months to show the inflow of business income to qualify for the mortgage loan. So for example, in a 12-month statement for this self-employed shows deposit of business income approximately $12,000 per month. We use a 50% expense factor, then $6,000 income can be counted as a income per month to do the loan. And the second type is the profit and loss statement loan. So we need a year-to-date profit and loss statement by either the CPA or the borrower themselves to qualify for the loan. So those are 2 types for self-employed. So the bottom line is that AA has been in business for over 30 years. So if you have any buyer with good down payment and decent credit, we can find a loan for your buyer. Thank you.
Okay, thanks so much. And we've been talking about non-QM loans a lot, so we have to finish it with Mario with a non-QM question before we go to Joe. So Mario, what are non-QM loans that we've been talking about today, and why are they why are they more expensive?
Well, non-QM loans, just keep in mind that they don't follow the Fannie Mae and Freddie Mac guidelines. That's why they don't ask for tax returns and all of the regular stuff that we would normally do, like FHA, right? It does cater a certain group, you know, self-employed in particularly. So why they're a little bit more expensive? Well, simply because it's a different investor. They don't follow those guidelines. And the more expensive means is on the rates. You know, and the idea here is for the realtor community to understand that for the clients, it says, I heard the rate is 2.75. Why am I getting 4%, right? So, or 3.75, and I have an 800 FICO score. Well, you're a non-QM. You're not submitting tax returns, W-2s like the standard type of loans. So that's the main message here. So it's the reality, there's not that they're more expensive, it's that they're, remember, the non-QM is mean non-qualified mortgage, as Judy has mentioned. They don't follow the Fannie Mae, they're not regulated by the Fannie Mae, Freddie Mac guidelines, that's my understanding. So that's why they have their own little capacity, their own way of approaching it with the 12 months bank statement, CPA, and all of this other little, so the message here is, for all of you to be informed. So don't compare it with what you hear, oh, the rates are this, why am I getting this? Your clients will question that, but then they have to understand that the difference that this is a non-qualified, it's not, that's why you're not showing tax returns or all of that other stuff. So that's really the main answer here on that one.
Okay, thanks so much. Joe? If a homeowner gets a loan from a private individual lender, what is needed later on when it's paid off to ensure my title is clear of this item?
Yeah, so in some rare cases, you could have a private loan on a property that is paid off outside of an escrow transaction, and so you don't have a title company officially like clearing up this lien for the future. So if you had a loan from a friend or maybe some small like little company that's not an institutional lender, it's important that they surrender the original promissory note to you as the borrower, that they show you the final amount due that you've just paid. You have some kind of record that it's paid in full, and also that they give you to record the full reconveyance document signed by the lender and the trustee. A title company will ask for this. If we're paying it off in an escrow, they'll ask for all these items. But if you were to pay it off outside of escrow, you need to make sure you get all those things. And if you're ever, if you can't remember these things, just, I would check with your escrow or title people when you're paying off a private loan, and make sure like they help you to oversee all the documents that you're clearing it up properly, because it could incur a cost later if we somehow can not see how you paid it off and you don't have those documents anymore.
Okay, thank you, Joe. Well, I just want to say a quick thank you to our speakers. I learned a lot today, so thank you for your time. We're going to go into the Q&A portion of it right now. So the very first question I see on here is, what is the difference between pre-approval and DU approval? And we're going to start with Judy. I know that you already answered Joanna's second question, so we'll start with this one.
I slightly covered it. The difference between approval letter is that bank or mortgage broker or loan officer can issue it just by whatever the borrower has told him that they make and how much asset. It's not fully vended. But if you go to a DU approval, you need to get your 222 ready, like 2 years of W-2 or tax return, 2-month paycheck stub, and 2-month bank statement to show you have the income and the deposit good source deposit to get approval. So it's fully approved, 95% fully approved. So it's much, much better. So people ask for that. Is that help?
Yes, thank you. Mario, I'm going to ask you this question. How much time is the pre-approved and the interest rate last?
Actually, pre-approval, typically, I would say 60 to 90 days. And there is a reason for that, because things can change on the credit report, right? What if in that you say 60 days pre-approval or 90 days pre-approval, and between that time, that borrower goes and buys a car or buys $20,000 worth of furniture, and that could make the difference between actually getting the loan and not getting the loan. So they continuously will be checking their credit report at the beginning and then towards the end to make sure that no additional debt is being incurred after they already had that pre-approval. So it does last, but it's usually, I would say, in the typical, and Judy can correct me, is usually somewhere about 60 days, 90 days, because changes could happen, right?
Right. It's correct.
That's the answer for that one.
Okay, I'm not sure if Joe, you want to take a swing at this question so we can go down the line.
Sure.
The question is, how has the pendulum swung back to easy credit in regards to no money down loans?
Oh, I think you should ask the lender. I'm not a lender for that question. Yeah.
Or Joe, let me ask you this. Are there different types of title insurance?
Yeah, so just like for a homeowner, there are different types of coverage for a lender. Typically all institutional lenders, all mainstream lenders, even some hard money lenders will get the ALTA extended coverage, which covers things that are sometimes like not found by a title company. And of course, if the title company's underwriter doesn't approve of the lender, they find there's too much risk, they may only give them basic coverage, which only covers the matters of record that they can see, or possibly like fraud, but nothing more than that.
Okay, thank you, Joe. Sorry, my dad was in the background and he was excited to see you on, Joe. Okay, so let me ask Judy the question that I had asked Joe. Has the pendulum swung back to easy credit in regards to no money down loans?
Can I answer this question together with Vincent Ho's question? It'd be easier just together.
Yeah, sure.
Okay. So basically, we haven't got to the 0% down, which we had before the crisis. We're pretty much down to 3.5%. You can get FHA. So it might be coming around with 0% down. Easy credit, I mean, we can do loan down to 500 credit score. It's pretty low. So it's already pretty low. So that's the question for that one. But Vincent had a really good question. It says, $1 trillion question, if not zillion. When will interest rate go up and down? Okay, so I mentioned a little bit, the factor that causes it goes up and down are stock market and the COVID-19, mainly inflation. So as I mentioned, in August, they will have this big annual meeting in Jackson Hole, Wyoming. So if they feel, the Federal Reserve feel the inflation is in place, which he doesn't feel is in place. He feels it's transitory. So he's holding the interest rate low by buying mortgage-backed security. But once they decide to taper off on buying this $4 billion a day, then we're going to start seeing interest rate go up, maybe to 3.5, 4.5. So there's some economic signs for that. Can tell. Okay, thank you.
Thank you. I do apologize. We do need to finish the Q&A right now, although we do have a lot of great questions within the chat box. So for the rest of the people that had the questions in the chat box, if the speakers don't mind, maybe take a look at that and answer that throughout the chat. We are going to go back to our affiliate spotlight because Marcus did have a little trouble logging on. So we're going to go back and let him do his affiliate spotlight. I just want to say thank you again to our speakers. We appreciate your time. We appreciate your knowledge, and thank you for being here.
Thank you.
Thank you, Sage, and all the panelists. It's a great information. And thank you for answering my question. Yeah. So affiliate spotlight, we have Marcus Jacks, Western Resources title.
Thank
Marcus,
you.
Are you ready?
Yes.
Take that away.
Can you,
Thank you.
can you hear me? Yes, I did the crazy thing of trying to update my firmware for my Wi-Fi, thinking it was only going to take like 2 minutes. It wound up taking 10. So we're ever learning in this COVID and Zoom time. Can you see my screen? Yes, there we go. I'm using a new software called Prezi to do my presentation. So here goes. Start with an introduction about me. I am a senior account executive with Western Resources Title. I've been there since 2005. And when I started, we were only in Orange County, but we've since grown to have offices in San Diego and in Diamond Bar, so we can be in the midst of all three major counties in the Southern California area. Little history. I was born in a small Gulf town called Texas City, Texas. Redundant, I know, but a nice place to go visit. We came to California when I was 3 years old. And then at the age of 13, because of my mother's my mother's employment at that time, she was an engineer for a company called Fluor Corporation. We were asked to go as a family to the Republic of South Africa, where we spent 4 very formative years. And then later, 24 years after that, my parents would spend another 3 years. Beautiful country if you ever get a chance to visit it. We came back and I graduated from Cal State University, Long Beach. And then in 1999, I decided that I wanted to give New York a shot. And I did for 6 months, but I missed the warm weather and came back to the California beaches and California lifestyle. What did I do before Title? Well, I worked in a hotel during college, and I thought during university, and I thought that I would be able to work in a hotel in the hotel business, but it was a little bit too stagnant and stationary for me. So then I got a job with an advertising agency because I had a desire to get into the acting world, and I did. I was working in an advertising agency and was making everybody laugh. And one day, one of my secretaries said, "You need to audition." And I auditioned for Universal Studios, got hired at Universal Studios to be a part comedian, and the rest is history, as they say. I got my SAG card, did a lot of Spanish speaking commercials. And the highlight of my acting career was actually being on an episode of Friends. But then they had strikes, and so I decided I need to get something more stable. I became a kindergarten teacher. I did that for 7 years. When one day my sister said, "You'd be great in Title." And I said, "Okay, great. What is that?" Well, here you have 16 years later. I love what I do in Title, and I do the 3 C. I call living my 3 C's. It's very important for me when I'm not working to be involved with my church. As some of you know, I've been singing in a gospel choir for the past 20 years. And during the pandemic, we had to bring church to people because we couldn't go to it. So as of March 12th of 2020, I started an online nightly prayer group, and we've been gathering since March 12th, 2020 daily to pray the rosary, which is our Catholic tradition, but also to have theologians visit us and give different seminars, and always there to pray for anybody who needs prayer. The second C would be my chicklets. Charlie Maria, who was born 10 years ago, and then Emerson Catherine, who was born 8 years ago. And I have a bone to pick with them because they have managed to make time evaporate right before me. It seems like yesterday were just pea pods, and now look at them, they're growing. And the third C is chums. My parents taught me to make friends wherever I go, and I've been able to make friends wherever I go all over the world. And making chums from all walks of life helps you fill up your page, every page of your life. So I consider you part of my three C's, my chums who have been a very important part of my life. And that's it.
Thank you. Thank you, Marcus, for sharing
That's
all the
me.
story.
Thank you.
Yeah, nice picture with us. Also, I would like to thank you all our panelists. I can see they are still answering the question on the chat box. Thank you very much. So the next, let's do attendance drawing for today.
This person is here, but I'm not quite sure how to unmute this person. Can you text on the chat box, say you're here? Fang Kish? Fang? Okay, we can always come back if that person doesn't apply. I know that Virginia is here. Yeah, she's here. And Fang just texted on the
chat box?
Yeah, but why is Fang is John Realtor? We have to double check. Are you Fang or are you John? Virginia, congratulations. Are you here?
Yes, I'm here.
Great. Text your email, please.
Okay.
Thank you. This person is here.
This is a difficult one.
Suai Chu.
Are you here? Could you type your email into the chat box?
Okay, sure.
Thank you. Oh, that was quick. We have all three all at once. Vincent,
Yeah.
First time, right?
Yeah, first time. So thank you again for today's panelists. And please remember to join our educational class. We have a 8-hour MLO live webinar, continuing education at 9 to 4:30 p.m. on August 3rd, the Tuesday. The cost is $129. And the financial fitness bootcamp at 11 to 12 p.m., just 1 hour on August the 3rd. Tuesday, the cost is free. And we have a 2021 Global Summit. It's on Friday, August 6th, from 9 a.m. to 12 p.m. The cost, please see the flyer. And the commercial webinar, how to make money by creating ADUs. Tuesday, August 10th, from 12 to 1 p.m., 1 hour. The cost is free. It's a very hot topic right now for ADU, and I hope you can join us. And for the next week, next meeting will be the next Thursday at 9 o'clock. And our speaker is our CRMOS CEO, Art Carter. His topic will be State of MLS, the current issues and hot topics. And that's welcome. August program chair will be William Wei, Pinnacle Real Estate Group. And visit us on our website, www.wsgvar.com.